No,
Give
we're
me a
live.
All right, there
Hello,
we go.
Oracles. How's it going? We're getting into it now. We're just some technical difficulties at the beginning here, but thank you for joining us tonight on this post-election day situation that we had going on yesterday. And today, awesome guest. Haven't had him on here in a long time. Darth Dividend. Thank you for joining us tonight. I appreciate you coming on here. Man, we got a lot to talk about, especially with the new president coming in and how it's going to affect the stock market and dividends over the next few years. So we'll get into that. So how you doing over there, bud?
I'm doing well. It's thank you for having me on here. It's been what, a year? We did a collaboration in September. We went live.
Yeah, I think so.
And yeah, feels like it was yesterday too.
Oh, I know. Yeah, time flies when you're having fun and investing in dividends because it's typically pretty boring.
Fun thing though.
Oh yeah. So we'll get right into it here. So obviously, Trump won the presidency. We saw the stock market boom significantly today. Don't think this is going to be long-lived. I think it's a lot of excitement and emotional swing into this, which a lot of people could have taken advantage of if you saw REITs were beaten up pretty hard today because that's how the market reacted. Typically, you see a huge overreaction when emotions kick in, could give you a good buying opportunity. And you had mentioned today as well on social media that REITs and BDCs could be looking pretty good over the next couple of years. So I own Vici Properties, I own Realty Income, I own Prologis. You, I know, have a little more extensive knowledge on that in the REIT sector. So what's your view on what we're seeing for REITs over the next year or so?
So for me, I will say with REITs, since the pandemic hit, they have not recovered at all against the S&P 500. They've been stagnant. A lot of the REITs like Vici Properties, Realty Income have been hiking their dividend and have been increasing their revenue, and funds for operation have been very good. So for me, I'm still kind of focusing on my principles and my philosophy going after the business development companies and the real estate investment trust. I myself, I'm like a hybrid dividend growth investor and an income investor, a high yielder, a little bit on the risky side, but I kind of, that's the way I do it. And Tim, with your philosophy, we discussed investing philosophies, with the yield max ETFs and the passive income, the monthly passive income, the weekly passive income. There's a lot of strategies that people have integrated with their investing strategies and passive income investing strategies. So right now I'm looking at the REITs. We'll discuss sectors and hot REITs right now. Of course, we're not giving financial advice. I'm just letting you guys know. But, there's some good ones out there.
Yeah. So, I mean, and we were talking about a couple of other ones. So, I like Vici because I think, the Vegas Strip is extremely strong. It's kind of on like their third wind right now with what's going on over there. Sports teams are going over there. So I think that's awesome. Realty Income, you can say there could be questions because of Walgreens and some of their clientele are, maybe not doing as well, but they're broad-based enough to be able to get through it. Prologis I have for the AI play as that grows higher. What other REITs do you have in your portfolio that you can recommend or, just even talk about, because no recommendations are financial advice, but anything that you can even just talk about that you may have in your portfolio could be other options for people out there.
So let's start with the experiential REITs. People have experiences and fun, and just like Vici, I'm pretty sure it's an experiential REIT. So I also have a monthly dividend real estate investment trust called EPR Properties, and that one is a major landlord for Topgolf ski resorts, and they were hit hard during the pandemic. So with their portfolio, they were heavy on AMC theaters, and they're starting to lower that a little bit and expand their investing strategies. So I like that with the monthly dividends. It's still taking time to recover. The revenue's up there. They suspended their dividend when the pandemic started. Well, I mean, nobody's in there. I mean, how are you going to make money?
Right.
So Vici Properties has done extremely well. That's a really good experiential REIT. My goal is to probably get to 300 shares of that one and then use its passive income to buy dividend growth stocks. Another one is Gaming and Leisure Properties, GLPI. So EPR Properties is EPR, Vici is VICI, and Gaming and Leisure Properties is GLPI. That's one that I'm really I haven't bought it in a while, but it's kind of a rival to Vici Properties. Very good revenue. Funds for operation have been up. It's a good high yielder. The dividends appears to be stable. Funds for operation appear to be stable. I mean, don't quote me on that, but I like the trends. I like the quarterly revenue trends. I like the yearly revenue trends. Yeah, and with REITs, you have to be very careful and study the revenue trends, because if the revenue is not there, like AGNC, you're not going to get a dividend hike, and it's just going to be stagnant. Maybe even get a dividend cut. That happened, or a reverse split, like what happened with NOY. So just be aware of that. But on the experiential side, I'd probably go with those three. Those are pretty exciting. And you can also argue that Realty Income does have a little bit of the experiential side with their acquisitions. So, they're very well diversified. Big company, things go bad, that's all right. One company does bad, that's fine. They're so big. I mean, they can sustain a little bit of a blow.
Right. Yeah. And they're not reliant on like one or two clients for most of their book, which is nice. And they're already expanding into other areas, like you said. Now, GLPI, where, like, obviously we know Vici is Vegas. Where's GLPI's main property located?
No, I can't answer that. I probably have to do another review on them, but they're pretty well scattered around the United States.
Okay. So they're not localized like a Vici. They've got more
Yeah,
properties around the whole US. Okay. All right.
Vici
That's
is
good.
expanding, so I'm going to
Yeah.
give them a little credit for that too.
Now, I mean, REITs have been great, and obviously, when you guys are looking at things like REITs, it's one of those. They're not going to have a lot of equity appreciation. That's not why you're buying a REIT. You're buying it for the higher yield and that income that's coming in. So when you see things getting beat up like this, it's kind of giving you that opportunity to basically buy more income at a discount, and that's one of the reasons we love this. And now you were saying that you're waiting to get to 300 shares. Do you drip all of your REITs right now?
So with my M1 Finance dividend portfolio, it's kind of the luck of the distribution. Whatever, there is an option on M1 Finance to individually invest the dividends, but right now I'm using all that passive income to kind of grow my main section. So eventually, it's going to get to the point where I may just buy 300 shares up front and just say, all right, I'm going to leave you alone and then focus on the next REIT like Prologis or GLPI or any of my dividend growth stocks, Lowe's, Home Depot, or something. So it's right now it's kind of just scattering around with the income and buying other fractional shares in my pie.
That's kind of what my thought has been recently as well, because I've got a few that are pushing, like I've got SVOL that's pushing 78, 79 shares. Like, do I just push it to 100? And and I don't drip any of those up in that sector for myself, because the way I have it set is, if my portfolio shows that I should buy it, I'll buy it, but I'm not just automatically dripping it right in, just the way I have it set up. So not dripping in. I've been thinking the same exact thing. And you just hit 100,000 in your portfolio this year, right?
Yeah, I did, and
Congratulations
it's
on that.
exciting.
That's a huge mark, and obviously that's something has been said before. Warren Buffett and Charlie Munger talking about getting that first 100,000. Do whatever you can to get there. Now, have you seen a big difference from there in your portfolio and the growth of it since you hit that? Has it really been that game changer, or has it not been long enough for you to even notice anything yet?
Well, some of my stocks are starting to woo. Like it's like when you have the fractional shares and the distribution. I mean, I bought a lot of financial sector stocks. Took a huge hit. The financial sector and real estate sector when the pandemic hit. Truist Financial Corp is blown up. Jackson Financial, JXN, that one's really good with the dividend growth. That one's blown up like crazy. Innovative industrial properties. We'll go into industrial REITs soon. But a lot of them have blown up, and then all of a sudden the distribution has changed. So recently, what I've been going after a little bit is the yield max ETFs, because I'm trying to create that strategy that we discussed, and it's starting to take an effect. I'll discuss that later with you on here. It's
Yeah.
an interesting strategy that I have.
Yeah. Because, and we'll get into that for sure, because that's something that, again, we were talking about before. So, guys, hold on. We'll get to that in a little bit. So now when you get to the other REITs, because for me, again, I've only got those three. The other sectors that are out there for the REITs, like I said, the industrial sector, things like that. What what other sectors out there that you think could be really benefiting from maybe this new presidency, or just in general with rates coming down? Because I think that maybe have more effect on it is the rates coming down versus just the president himself.
Ooh, that's like 5 questions into one. Like, whoa, like let me try to dissect this. But I do think the industrial REITs are going to be pretty strong. Prologis, I think out of all of them, and the triple net lease, NNN, Realty Income, Agree Realty Corporation, those are always going to be strong. But I for some reason, I can't, I don't know if I'm going to be accurate or not, but the industrial REITs are looking pretty strong. Innovative industrial properties. So that's a Mary Jane. I'm not going to say, we can't say what, but Mary Jane. So, now they're talking about discussing legalizing Mary Jane. That is a very specific REIT. I'm kind of upset, but they're finally coming back together and knocking into their senses. But AFC Gamma, they all of a sudden decide to say, oh, we're going to be commercial real estate. We're going to do Mary Jane. So they finally realized, okay, we can't do both. We got to separate that. So hoping they make a comeback. I may just take a risk, and I'm just for play money. One that kind of upsets me a little bit is Stag Industrial. That's a monthly dividend REIT. The dividend growth is probably slower than the Browns' progress when they get players.
Oh, that's so bad.
Player development. So that's kind of upsetting. It's still good. Net worth, that'll increase your net worth. It's going up there, but just the dividend growth is not, it's a little slow. Hopefully it comes, starts blowing up, but that one's starting to get really big. Another one is Rexford REXR. That's actually specifically just California, like industrial REITs. And that whole area is huge. So they're generating, pretty good dividend growth. And of course, Prologis. Prologis is probably the best industrial REIT, the biggest one out there. And it's a good bang for your buck. And the dividend growth is starting to get up there. The FFO is good. That's one that I need to get to 100 shares. That's one of my goals. I want to get to 100 shares of Prologis and say I made it to 100 shares.
Yeah, for me, and we were discussing it before, that's one of the ones that is the only one that I've been cutting down on just because of the way I'm playing my portfolio right now. But I don't want to get rid of it. I just thinned it out for the moment, and I'll be adding back to it later just because it's one of those ones that does fluctuate so much. I bought in at $100. I sold some at 130. I bought more at 136. It's now at 112, 114. This thing is all over the place. It does not move like a normal REIT does. So you definitely get a lot bigger swings in Prologis to give you some better buying opportunities. Heck, you could even almost swing trade Prologis. It's wild.
Mm-hmm.
And then the dividend on it, the yield itself is only like 3.5% to 4%. So it's not anything to write home about for a REIT, but for a regular stock, it's actually pretty good. That's on the higher end. If you wanted a dividend growth stock, that's kind of why I put it into my dividend growth stock category, because it really is more like a dividend growth stock than a REIT.
Mm-hmm.
But you really can't, I don't think you can go wrong with it. I think it's going to be great long-term. And if you can catch a downward swing like we saw for the last couple of days, could be a great buying opportunity for people.
And I was going to also discuss the healthcare sector. I have that one is taking a hit. Medical Properties Trust, they took a major hit. Hopefully they'll make a comeback, but they're a big one. But, with this pandemic going on and, this is just my theory, and some people agree, disagree, but nobody was in the hospital. Nobody was in the skilled rehabs, and they were dealing with debt, and then they had to deal with Stewart Health. They may have a reverse split. I'm crossing my fingers for them. I hope they come back and, I'll rebuy them. Mega Health Investors, OHI is a high yielder. So that one really hasn't hiked its dividend. I'm in Care Trust REIT, CTRE. I've been buying that. I sold it, rebought it. I'm buying more shares right now as we speak, and very excited for that one. So CTRE is one that I've been buying. That one's a little risky because you look at diversification and size, like you look at Prologis or Realty Income, they take a hit. They're still fine, They could, whatever happens, pandemic proof, recession proof, they appear to be like that. And I was going to also mention the net lease REITs, the triple net lease ones, and hopefully I'm correct on this, but NNN is one.
Yep.
That one is a very hot one that I like. It's the dividend growth is a little bit slower, but it's big. It's a big one.
Yeah, I like NNN for sure.
What was the other one I had? I should have wrote this down.
NNN, there's Agree is awesome.
And there's a few of them that I also have been buying. I'm going to actually go on my M1 Finance real quick. See, NNN is a good one. Agree Realty Corporation is a monthly dividend REIT that I've been that I'm going to start buying very soon.
And Agree is very much like Realty Income.
Yeah,
it's almost like the smaller sister version of it.
Four Corners Property Trust. I want to go over that one too. So restaurant business, that is a restaurant REIT. So they're a major landlord for a lot of restaurants. So I've started to buy them as well. So FCPT, I want to make sure I got the symbol right. That's one that I've been buying. So, I mean, we can go on and on with REITs, but we may have to next time, especially with these triple net lease. There's really good ones. And I can't list all of them at once right now, but I'm going to have to show you my list of my REITs that I have. And discussing Realty Income and Agree Realty Corporation, my goal is to get to 200 plus shares. Oh, my foot was tangled on the cord. But so what I'm going to do, and you discussed your income strategies, like you don't reinvest certain things. What I'm going to use is my income from my business development company, Horizon Technology Finance. I'm going to just make sure I got that one. EPR Properties. I'm going to use the quarterly dividends from Arbor Realty Trust, and let's see that one, and then Glad. Or I'm going to use that passive income to reinvest in the Realty Income and reinvest the dividends with Realty Income, and try to get to 200 shares. I'm at 168 shares, so I want to get to 200. Just continue to reinvest. That way, I don't have to touch it anymore. I just reinvest the dividends, and then that income with that is going to start loading up Agree Realty Corporation. So I want to get to 200 with Agree Realty Corporation. Crazy thing is, Agree Realty Corporation is more expensive than Realty Income.
Yeah. But I think that I'd have to look at the shares outstanding. It's got to be strictly because of shares outstanding. That's got to be why. Yeah, and that's very much like what I'm trying to do. It's just that reverse snowball. And anybody out there who's tried to get themselves out of debt, understand, use the debt reduction snowball basically to get yourself out of debt. Once you're out of debt and you can start investing, you can reverse that strategy entirely. And instead of having to use your money to snowball out of debt, you can build that snowball bigger through your portfolio. Mm-hmm. And so, that's what it is you take that money and you say, all right, well, I've hit the level I want to for this stock or ETF or REIT, whatever it is. And you take that money and put it into another one. And then that grows into another one. That grows into another one. Now your snowball of cash and this cash flow coming in, it just gets bigger and bigger. And then you can go and spend it on other things. And that's the wild part, is just reversing that whole strategy. It's awesome. Mm-hmm. So now we'll shift gears over to, we'll go into some BDCs. Because some of these did very well with higher interest rates, may not do as well with lower interest rates, but the risk comes down on them because of lower interest rates and the money that they loan out. They could end up getting, more of that money paid back because the loans are giving out aren't going to be as hard for these companies to pay back. Mm-hmm. So what BDCs do you currently have in your portfolio?
I have a pretty good amount. One of them is Main Street Capital, monthly dividend.
Yeah, that's my absolute favorite one.
That one, I need to get to 200 shares. I just have this goal, 200 shares. I mean, obviously I want more than that, but
right. But it's a good milestone.
Yeah, it's a very good. I mean, revenue. If you look at the revenue trends, it's fantastic, and it's done really well. And you get a special dividend here and there. So that's
all the time. Like so many special dividends. It's wild.
Another one is CSWC, Capital Southwest Corporation. I need to get to around probably about 250, and then use that passive income from that to buy the dividend growth stock. So I'm going to use that. Hercules Capital, HTGC.
Love that one.
That one I'm going to use, and we can both flex like Hercules.
I was gonna say that
Yeah,
one got beat up pretty hard over the last month, and they had a rough earnings over August, so it took a big hit, and then it like kind of trickled down a little bit, but they just raised their dividend like 20%. It's
I know.
insane. So I'm like, well, I'm not going to not buy. I can now buy a 20% higher income for less money. Of course I will. And I think the yield now is over 10% on it.
There's one that I sold. I'm just going to closely watch. I hope it returns. Triple Point Venture Growth. That's one that it started to take a hit. I did a little dollar cost, I'm sorry, tax loss harvesting, and I threw it into NVDY. And I'll discuss NVDY, what I plan on doing with that. Another one is Saratoga Investment Corporation. The Black BXSL, the Blackstone one. That's another one that I have.
I contemplated getting into that one also. I heard, I think it was the Blackstone, something with, I don't know if they're real estate sector or something, took a real big hit or something from Blackstone.
I think I got the secured lending fund, BXSL. That's the one that I'm looking at. TSLX, I have that one. Pretty sure I got the symbol right. There's.
Do you have
Aries Capital? I was going to get there. Just trying to think of I have so many. My goal is to get to 200, 250 with a lot of these. I'm pretty sure I have GoLub Capital. That's another one. But you have to just be very careful because the revenue trends aren't good. They have cut their dividend. The consistency isn't there versus the dividend growth stocks. But myself as an income investor, who says no to an extra $1,000 just on passive income? It's not consistent, but it's no guarantees. But hey, extra $1,000 to reinvest into my dividend growth stocks, and that's what I plan on doing with the Yield Max ETFs. Is throw it in there, buy the dividend growth stocks, and then flip it eventually, and then just live off of it.
Yeah, because that's exactly what my strategy is right now I'm kind of using, the Yield Max, those ultra yields, and even these, higher yields with the REITs and BDCs to kind of, turbocharge my longer term plan of, the dividend growth stocks, which, they're going to get the equity appreciation and the growth over time. Plus those, when it comes to taxes, are taxed at a much lower rate. So right now, the things that we're talking about are typically a higher taxed type of dividend that's coming in. So be very cautious with that when you're doing it, because it does affect your taxes at the end of the year significantly differently, depending on what you have for regular income coming in. So I'm taxed at a higher tax bracket. So for me, any REITs, BDCs, SVOL, a lot of those ETFs, those are hitting my taxes hard. Now, of course, I've got real estate and other things like that where I have the tax write-offs and balance it all, but not everybody can do that. But the long-term plan is to be able to take all of that money, put it into those, the VU, JP Morgan, Nvidia, those kind of stocks that are going to be dividend growth stocks that you'll get taxed at a much lower rate. That's what we're doing this for. So that's we have a very similar strategy in that regard. So now a question I do have too is, because you are very diversified in a lot of these different categories. Like I have 3 BDCs, I have 3 REITs. What is your reasoning for having as many and not just consolidating down to like the 2 or 3 best ones?
That's a good question. It's for me, it's like, do I have to reevaluate my strategy? Do I have to do this? But I think certain dividends are distributed at certain times. So the reason why you and I like, the weekly income ETFs, we earn weekly income. So to try to strategize a schedule so that I earn dividends every week, 100, 200, I'm getting to the point sometimes where I make $500 a week in dividends, which is exciting. So so far it's working. I probably am over diversified. I tell people that I am. You don't have to do what I do. I do have a lot of stocks, but right now the focus, it just depends on the stock market. If the stock market's taking a huge hit, yeah, I'm buying dividend growth stocks. And then if somebody takes a huge hit, Home Depot or Target or somebody, I'm going to target that for a little bit. But since the economy, the stock market's starting to blow up there, I'm going to focus a little bit on the income But again, the long term is I'm hoping in the next 5 years to have all my income stocks start buying the dividend growth stocks and get to 200, 300 shares and just use that, like for example, let's just say CSWC, their distribution is pretty nice. They use $200 every quarterly to buy a dividend growth stock. I mean, how are you going to say no to that? You have
Yeah.
7 or 8 of those,
Yeah, and that's kind of like what my thought was as well, is especially in the type of market we're in right now where we have been going up significantly, but you can get some fluctuations very rapidly in the market. Whereas if I was only getting, paid quarterly or maybe once a month and had this money once a month to utilize, then I might miss out on a little bit of a dip earlier in the month.
Mhm.
So to your point, having that income cash flow coming in on a weekly basis now gives you a lot more versatility in the market to take advantage of these things. Now, do you have like a cash stockpile as well? For me, I kind of keep my portfolio around that 10% cash mark. And if I see opportunities, I'll have that cash and don't need that cash flow. So do you have a cash pile, or you just kind of go on the cash flow?
I just go on the cash flow and dollar cost average pretty much. But
Okay.
the best way to describe my investing strategy, because somebody's like, "How do you do this? Why do you buy so many?" So I kind of picture my investing strategy as a monopoly board. Okay, your foot's on this, $300. Foot's on this, $700. So it's almost like the person's walking around the monopoly board the whole time. So that's kind of the way I'm treating it.
Okay. And you just you're trying to buy all the properties on the board. So no matter where they land, you're getting paid.
Yeah, pretty
Nice.
much. That's
Okay.
probably the best way to explain it. I created my own ETF on M1 Finance.
Okay. No, that makes sense. And like I was actually going to switch over to M1 Finance, and we were discussing it before, and that's kind of how I've set mine up as, and I've got this beautiful spreadsheet all set up for me to track just that. And so if you guys don't know what M1 Finance does, is it's got your pie charts and you put in there whatever stocks and ETFs you want, and you set the criteria for it. But correct me if I'm wrong on this, but you set the criteria, and as you get cash coming into it from whatever dividends you have, it will distribute that based upon where the pieces of pie are in the chart. So if something is sold off, it'll add to whatever has sold off. Is that correct?
Kind of, or whatever the higher percentage is. So say like, REITs have taken a big hit. The passive income is going to focus on the REITs that took a hit. But now M1 Finance is allowing you to have your individual stocks. So say like you have 50 stocks, okay? 49 of those stocks will reinvest into the other stocks, but that one stock, say like it's Prologis, can invest in Prologis itself. So now they made it a little bit more unique, but I'm still just focusing on just building up that pie and just going from there.
Okay. Yeah, and for me, that's what I did, was I just kind of took that strategy from M1 and used it for myself and just kind of
Mhm.
morphed my own. And it's my own little kind of dollar cost averaging strategy, but I did it in a more unique way for me. Whatever, I enjoy it. Um, so so now a couple of odd ones before we get to the yield max stuff. SVOL is kind of like an oddball. Do you
Mhm.
own SVOL?
No, I do not.
Oh, I'm actually shocked. Is there a reason?
Well,
Is there a reason you don't? Just out of curiosity.
I mean, right now I'm doing this yield max, ProShare strategy, BITO, and all them, and then I'm probably going to be adding it. It's just
Okay.
right now, but SPOL, I mean, it's pretty consistent. It's good income ETF too, but no, I do not have it.
Okay. Now, have you looked at other ETFs like the covered calls, like the JEPQs, JEPIs, SPYI, QQQI? Do you have any of those?
The Neos ones, not yet. Right now, it's just kind of the focus with kind of getting the yield max and pro shares and the BDCs up there, and then I'm going to start going to the more consistent ones. So that might actually be. I have two dividend portfolios. I want M1 Finance and I have one on E Trade. So the E Trade I have Realty Income on. E Trade I have M1. I'm sorry, not M1, but I have Main Street Capital on.
Yeah.
Okay, I have EPR Properties on there. I want to get to 200 shares on E Trade. So right now the big focus is on M1 Finance. So I want to get to a point where M1 Finance, I'm generating enough cash flow, enough income, like we were saying with the monopoly board. I don't have to touch it anymore. And then I can focus on E Trade and focus on a different investing strategy. So Right now, probably for the 5 or 6 years, it's mostly M1 Finance. Build it up, build it really powerful, never have to touch it again.
Okay. Now, you were talking about pro shares. I don't know, maybe I don't know my own stocks, but what ETFs and stuff are in pro shares?
They have a Bitcoin one that I really like, and that's high yielder. So it's a little bit safer than the yield max one. It appears, don't quote me on that. But that one has a really good distribution. It's monthly, and I've generated some pretty good income with it.
So
And
that's like the competitor to Ybit.
I would say so, but it's better. I think the
Okay.
ProShares one is
And what's
better.
the ticker on that one? You said it was what, BITO?
I'm pretty sure it's BITO.
All right, I'm going to write that down because again, this is now we'll get into it because this is one of the things I was looking at, and I don't want a huge chunk of my portfolio to be in those because they're not as consistent, but it does give that nice injection of cash. And again, one of the things to pay attention to is making sure that you're not getting into something that has a lot of NAV erosion, because when you get high yields, you can definitely be susceptible to that. You know, one of the things we had talked about previously was KLIP, and it showed it, but man, it just never turned around. Just took a beating. You know, if you caught it at the right time, it could trade flat for a few months, and you could make some good money. And I made a profit on it anyway. But if I held onto it longer, I definitely would have taken a beating on it.
Yeah, it right now I'm at 25 shares. So I wasn't like being rude or anything. I was just looking at information. I'm up 29.74% because it follows Bitcoin, but it gives nice passive income with it. So just letting you know, that's one. There's one that's an Ethereum one that's like really good. I've been begging M1 Finance to get on it. I think I'm gonna have to check my old archives and the chats and M1 Finance, but I'm not trying to be, cocky or anything, but I tell them to put it on there, they put it on there. They go, oh yeah, right away. Yeah, thank you. And they start tagging me and, posts. I'm like, okay, all right, we're good.
So now, then this is through ProShares as well, an Ethereum one?
I think that I might be the Roundhill one, actually.
Okay.
It might be I'm pretty sure it's the Roundhill one.
All right,
The Ethereum one.
I'll put that on my list just because, again, those there, cryptocurrency obviously can move significantly. Donald Trump supported cryptocurrency. We'll see if it actually comes to fruition and whatever happens from there. But, if someone is a believer in cryptocurrency doing well in the long term, something like this should also do well, especially with the volatility, because that's what a lot of these covered calls go off of, is that volatility.
Yeah.
So now looking at these yield maxes, again, they've got a giant list. They keep on growing it. And it seems like the NAV is great, but it's like whatever the next hot one is where all the money goes to. And then older ones kind of just lose that. I've been in Coney, and man, I caught that at the right time. That thing took off, and I have more than doubled my money on it. I can lose everything from here on out, and I'm still up on it. So that one's done very well. MSTY, Master Strategy. Oh my God. Like anybody or MicroStrategy, anybody who owned that one, I think this last dividend, they paid out $4 a share. Insane. And that had crazy equity appreciation. Like that went up over $40 for it. And that's why Coney for me was awesome, because I bought it, had 100 shares, took off. It was pushing up to $30. I sold somewhere around the $28, $29 mark. And so I made that profit, and I was still getting paid all those high dividends. And so now it's below $20, but I still made all that money. So now, obviously, this is a huge focus for you. So what are some of your favorites? Because I want to add them to my list and put them on there as I grow mine.
So I was going to bring up Coney. I did the same thing. I sold it for a profit, and I'm actually rebuying it. So I waited, X amount of time, and I rebought it. NVDY is my favorite, probably, because it follows NVIDIA. NVIDIA appears to be fine. There's no bubbles or anything at the moment. But actually, the one PLTY is one I'm very closely looking at, the Palantir one. And Palantir has been going up a lot. Very volatile stock. I mean, it was $6 at one point. Now it's getting back up there. The earnings has done pretty well and stuff. Their most recent reports, they've been really doing well with AI. Everything, actually, the hospital I'm at for my travel nursing, you see Palantir Foundry. So I mean, they're doing pretty well. They're pretty well diversified. So the AI I'm looking at a little bit. MSTY, I'm starting to load up on them. So what I did is one of my stocks, KeyCorp, the dividend growth was not been doing well. So I sold 8,000 of Key Corp and threw 8,000 in NVDY on E-Trade, and I have 8,000 in NVDY in my M1 Finance. So each month I'm using the passive income from E-Trade to throw into M1 Finance and create a, buy more shares. That way I can start getting it bigger. So I'm starting to do that now because we discussed that last time. That's kind of what the strategy and the goal is. I had a few roadblocks going in. It's somebody fraudulently used my credit cards. I was telling you about that. I finally got that taken care of. And it was for a trademark application, and finally got that involved. And thank you, Visa, by the way. And
Love that stock as well, by the way.
And I'm a shareholder of Visa. Thank you. And MasterCard and Capital One. I want to thank them. And actually Key Corp and what is it? It's a company. It's a Visa, BP Visa, FNBO. I want to thank them, by the way, for helping me out. It was 6 months of headache, and it threw me off the side, from studying for nurse practitioner boards, which I am now a newly certified nurse practitioner. So
Nice.
got that out of the way. That was headaches, a lot of hours, phone calls, police reports, blah, blah, blah. But now I'm finally able to get to have this focus on everything. And I'm going to start the money I get back from what they fraudulently did with one of my cards. I'm going to throw it into E-Trade, and then each month use that money from MSTY, like what I'm doing with NVDY, and buy MSTY on M1 Finance. So then I'm going to start using that income from those two to buy my dividend growth stocks and buy my high yielders and stuff. So it's starting to really kick in. I mean, the income, I'm at the point where I'm making like 1,800 a month, and I'm just reinvesting that into M1 Finance, buying dividend growth stocks, buying Starbucks, buying Pepsi, buying Coca-Cola, the really good dividend growers, Home Depot, those ones, really starting to do that. SQY, I've been buying a little bit. FBY, I've been starting to buy a little bit. But really, I think the three that are the most powerful right now, and I don't know how long that's going to last, because if there's a Palantir bubble, but PLTY is probably going to be pretty powerful. MSTY and NVDY, those three I absolutely love, and I'll take a risk with them, if something happens. But they have been done incredibly well with passive income, and CONY is starting to make a comeback as well. So there's a lot of good ones out there, and you and I were in TSLY. Bubble hit. I mean, they were doing really good.
Oh, I made great money with them until then it reverse split, and I'm like, Matt, I gotta back out of that. And that's the only concern I have with a lot of those yield max ones is, and of course it's all going to come down to where do you think we are in the market? Do you think we're going to sell off? I think we may get a recession next year, which may not be great, but buying them at that time could be a good opportunity. So timing of buying these does make a big difference. And looking at something like right now where we just saw this massive pop in the market today, maybe not the best time to buy, maybe let this cool off a little bit, but maybe we do continue running. So obviously you've got to use your own judgment. I know this is financial advice, as we say, but that's my whole thing. And then looking at, obviously the NAV erosion is real on some of these. And so some of these here is, and kind of what I looked at TSLY for is, I'm not holding onto this long term. This is not anything, hey, I'm going to hold on to this for income forever. This is basically a 2 to 3, maybe 4-year play at the most. Again, just to get all that cash coming in to give that injection to the rest of the portfolio. So again, then you come down to this list, and I'm going to take a look at that because I was making a list earlier today, and that's basically the same. AMDY was a good one as well. Not sure, how that is, but I also looked at, they have so many other options that are almost on the conservative side, we'll say, like a Zomo, XOMO, JPMO, and I don't know if you've toyed with any of those. Obviously, your focus is strictly what's the highest yield and income I can get. Makes a lot of sense.
Yeah.
Does it, for you looking at it, and me from more of a conservative angle, is it worth getting into one of those other ones because they're not as volatile and probably won't have the same NAV erosion, or just say, balls out, go for it and go for the higher income?
Well, everybody's different. It probably would help to be a little bit more conservative too, because I probably will get more conservative with the yield max ETFs in a little bit, but the
Obviously,
high
you're gonna ride it as long as you can. Obviously, it's doing great
yeah.
for you. So
I mean, me, single, no kids, travel nurse, I can take a hit. That I tell people numerous times in my videos and my posts, like, hey, I can take a hit. If I lose X, $3,000-4,000, not the end of the world, because I have all this other stuff. I'm well diversified. The reliability, I just want to make this clear. We discussed this before, even with KLIP, the reliability is not there. So long-term wise, okay, Realty Income, Prologis, Coca-Cola, Starbucks, they're going to be the winners in the long run. It's like the tortoise and the hare, okay? And I always joke around with people, they always ask me about the yield max. They get interviewed all the time. I said, well, it's like dating somebody that you're going to have a little bit of fun and have a little bit of a ride and party with and this and that. But would I introduce that person to my parents? No. That's kind of the way I describe the yield max ETFs. And, when you want to look for commitment or marriage material, long-term material, they got to be obviously, you got to be physically, emotionally, all into it. And, dividend growth stocks are, you want to build a relationship. You don't want something stagnant. So
yeah,
it's great. I mean, I made a lot of money with TSLI. I actually did have returns. I mean, there was one month I was making like, what was it, $2 a month?
it was awesome. Oh yeah,
This year.
it was like Tony making 3 and change. Ooh, such good times.
So reliable. How I don't want to be rude, being like a nurse or something, but it's like dealing with a patient that just does not take their bipolar meds.
Yeah,
that's the best way to say it.
And it's funny too that you brought up the, not taking them home to your parents, because my dad watches my channel regularly, and that's literally it. Like, we'll discuss that, and he's always kind of like, I don't know about this one when I talk about anything higher yield like that, because again, parents would not approve, and my dad does not really approve of that. So, he's like, you know what, you're going to make your own decisions. You're a big boy. You go do what you want to do. But just like you said, it's not something you're going to take home to your parents that they're going to want to see you with all the time.
Yeah. Well, I mean, I may rebuy them. I mean, I really like their investing strategy. The Israeli shipping company, they took a huge hit. I mean, it was a lot of stuff going on, the war and this and that. I like their business philosophy. You're a shareholder. Each share you own, they give you money. They're like, well, it's a yield trap. Well, define yield trap. I mean, I'm doing it just to get money being a shareholder. I want something out of it. They're very unique and diversified. I mean, I'm not relying on them for it. That's like throwing stuff in a dartboard, It's like somebody that has like 7 or 8 shots of Crown Royal and they're throwing darts,
Oh, right.
And
again, you could say that about KLIP, because you look at that one there and clearly massive NAV erosion. You can't even hide it, but I still made money on it. So can you fault me for having a positive return on something and getting that cash flow that I was using to buy other better quality ETFs and stocks? I mean, it really comes down to, whatever you're using it for, what your investing strategy is really it, and obviously you don't want to buy something that's going to be just a straight up loser. There are plenty of those out there. But again, if you're using it for a specific purpose and that purpose is going to generate more returns for you in the future, are you really wrong?
Well, again, let's refer back to the relationship long-term material. Okay. When you have dividend growth stocks, Prologis, we'll just keep on bringing up Prologis. Do we have to keep an eye on it all the time? No. It's going to do well. It's commitment material, long-term material. You're with the yield max stuff, or if you dated a girl that loves to party and go out like crazy, you got to keep a closer eye on her, in case something happens. So that's kind of the way with yield max too.
And they're also good ones too, because they're those, sometimes single guy and you've got some needs. Hey, I'm going to go grab that one, get my needs fulfilled, and then move on from there.
I don't do that. I'm just being honest.
I'm not saying, but just, knowing how life works, but that's one of those, things where, hey, it's out there. You've gotten,
it's a good correlation or reference, but but I mean, you and I have different principles. We are not like that. I just want to make it clear.
Yes, correct. Yes, that is not how we roll, but just to make that, yes.
Yeah, it's strip club stocks versus stocks that you want to display outside on your door frame. There you go.
Exactly. So now the yield max, and so I'm going to start looking at these because the way mine is set up, I kind of set myself, and they are basically arbitrary levels that I set for myself, but the little stepping stone goals, kind of like you've got your 200 shares. I've got my certain dollar levels that I want to
Mhm.
get to, and I'm getting pretty close to hitting, like I have basically level 1 and 10 steps in each level. And I'm about to get to the end of step 10 in level 1. That'll put me at level 2. And that's where I'm going to add back in another one, or I'll add maybe I just add more Coney and just build more
Mhm.
on that position. But I like the idea of having those either weekly payments or, I like what Yield Max did was they kind of broke down into different, every single week they have a different set of payments. So this way,
Mhm.
if you buy a certain fund, you'll know what week it's going to pay in. So it's not all in one week. And so this way you can kind of break it down. So I like how Yield Max did that. And
Mhm.
so I've got Coney now. I also have, and I tried them, not sure if I'm happy with them or not yet. They just started paying weekly, but the put ones, WDTE and QQQY. Are you familiar with those at all?
Yes, I'm pretty sure those are the Defiance ETFs, right?
Yes.
They did do a reverse stock split, I think. Those
They
ones.
did. They did on both of them. That's why I contemplated selling out. Then they switched to weekly, and I'm like, let me just see how they're going to play with weekly and the reverse split.
Yeah, I haven't. I did sell them, and I did sell them for a profit. That's probably a stupid idea, to be honest. I should have tax loss harvested because I know I'm going to pay the price next year. I'm looking at them very closely. But it just seems like QDTE, RDTE, and XDTE are a little bit more um, controlled, a little bit more controlled. They're kind of like YMAG and YMAX, but
Yeah.
people need to realize these expense ratios too. But
Yes.
but again, we were talking about reliability. QDTE, RDTE, XDTE. Now I love the weekly income. I mean, some people are making like $300 a week. I
Oh
see
yeah.
it on X. Uh, sure, I mean that's one goal that I would love to have, and just buy dividend growth stocks, or who knows, pay for something. But consistent, all my subscribers yell at me, oh, come on, it's a great thing. But again, consistency, $18 a week. Say, like, if you have 100 shares versus $20 a week, and then $5 a week, so again, the consistency with the passive income is not there, but, it's good to have some nice supplemental income. So I just love the weekly income. I love it. I reinvest it into actually the yield max ETFs right now. So I'm hoping that I get to the point where, and I probably should buy QDTE, RDTE, and XDTE on M1 Finance, or I'm sorry, E Trade, and then throw it into M1 Finance each week with those. So that's one thing I do have in mind. But my income I'm earning on X and YouTube, I might just throw it into a pie with those three and just keep on building that up. So that's one thing I have in mind.
Yeah, like in the QDTT and XDTE, I've been looking at those as well to add in. Now those are lower yields, well, lower compared to like the yield max. They're like 20% ish
Mhm.
yield. But again, one of the things I looked at, and that's one of the reasons I ended up buying YMAX, is the lower yield also helped prevent a lot of the NAV erosion, or at least slow it down quite a bit. So for
Yes.
me, at least it gave me more time. So I may not have the
Mhm.
same amount of cash coming in, but it's going to be more consistent, and I'm not going to get the NAV erosion as quickly. So that's the reason I did that. Probably the reason why I'm going to jump into QDTE also, just for that reason, is
Mhm.
just because having that cash flow coming in on a consistent basis without the NAV erosion. That one actually has been doing well without NAV erosion too. So definitely looking at that. And I do very much the same thing. We're saying with X and YouTube, all my YouTube income, my Patreon income, and
Mhm.
it's not a ton, just because I've shifted the channel a bit.
Mhm.
The algorithms really don't like when you do that. So, but again, all of that money that I have coming in goes right into my portfolio.
Mhm.
That's why I'm doing it, for that extra money. And that's why I
Yeah.
recommend to people as well, get a side hustle so you can pay down your debts and then use that extra side hustle money to invest. And you
Yeah.
do it whatever way is best for you.
And that's what I'm doing. I'm travel nursing. So the stipend pay, as long as I show that I'm doing stuff, my stipend pay, I use that extra money just to load up my dividend portfolio.
Oh yeah.
And it got me student loan debt free. I owed $20,000 in student loans from NP school last August 2023. Well, I paid that off. So I'm student loan debt free. And I drive a 2012 Camry. People joke around like, why do you drive that? I'm like, well, what's wrong with it? I have 136,000 miles, you know?
It's so funny because that's exactly the car I leased right after I got divorced, was a 2012 Camry. I love that car. It was awesome.
But, so my friend asked me, how would you describe TSLA? And it's great, not great, but I always crack a joke. And there's a girl that used to live in our complex, that used to live across from us. We would nickname her Reptar. And when she drank, whoa boy. So that's, you don't know what's going to happen with Reptar when things go bad. So that's the best way to explain TSLA. It's things go bad, it could go really bad. So it's better to be diversified. And again, I like to focus on the dividend growth stocks. And I have in my other portfolio, everybody says, well, you just buy yield. Well, I have a growth portfolio on the side of IRA. I have a few IRAs. And on one of my IRAs, I have like 117 or a lot. I have a lot in NVIDIA and I'm starting to load up on Apple. I rolled over my IRA from my employer into a Fidelity one. I have it all in pretty much VGT right now. So, and I have another IRA and here and there. So I'm pretty well diversified. But, when you look at an IRA, you're talking about VOO and stuff. I don't think it's a good idea. I know the returns for NVDY have been phenomenal. It's like a 200% return with reinvesting dividends, but I don't know long term if that would be the best idea for an IRA.
Yeah, and so you guys know as well. Yes, today we talked about a lot of the higher yield stuff, getting into yield maxes, REITs, and things like that. But again, we both have huge dividend growth, and that is not something that we're going to be doing long term. REITs, BDCs could be longer term, but you look at these, especially when you look at NAV erosion, expense ratios are stupid. You're going to be losing so much money on all of that. We have all these portfolios. The whole focus is to have these as cash flow to go into, the stuff that we'd put in our IRA. I would never put a yield max in my IRA, but I've got a couple of REITs in there. I've got Realty Income in there. I've got Vici in there for the, the income coming in, but I have other dividend plays. And those are going to be things that are just going to be dripping over time. I've got, VU in there. I've got QQQM in there. VTI is in there. These are longer, broad-based ETFs that are the solid ones that you want to go with. These are the things that are going to be great long-term. So just so you guys are aware, we're not just going haywire with these income ETFs all over the place thinking we're just going to be living on that, because we are well aware that's not a sustainable path to be on. But again, to inject into those other areas to speed up that process, that's kind of why we do this. So just wanted to make sure you guys are aware of that. So again, to reiterate, none of this is financial advice, all for entertainment purposes. However, looking at it just to make sure that you are doing what's best for you, and it's all coming down to risk tolerance and things like that. Oh man, is there anything else you got? We're going to start wrapping it up. It's been a while, and I know Darth's got to get some sleep.
I can do this all day. I'm not working tomorrow. But so
oh, nice.
Another thing is with REITs, like you have your REIT in your IRA or your retirement portfolio, you don't get taxed on that income. Right. So that's the nice thing. So you get net asset value growth, and you get dividends buying more shares. So, and you don't get taxed on the passive income. So a lot of people use REITs and they put them in their IRAs. So another one is it Crown Castle? That's a pretty good one. I don't own Crown Castle, but that's a pretty good one that people put in their REITs.
American Tower.
Yeah, I have American Tower. I love them. Good communication sector REIT. I'm trying to think what else I'm touching base on stuff. See, we did the healthcare. We did the triple net lease. Just some wild card REITs. What about Getty Realty, GTY? That's one that I really, really enjoy. So it was almost like an arms race for all these REITs. And you'll notice all these REITs, they have car washes as part of their portfolio now. Getty Realty focuses on car washes and a lot of car stuff, advanced auto parts. You can correct me if I'm wrong, anybody watching this, but they're very focused on automotive stuff. So they're a landlord for that type of stuff. So very interesting. I like that one. And I need to get to around 100 shares, but
Then you have
very exciting. What's that?
the storage REITs you've got also.
Yes. Oh, I forgot to mention that. NSA is one that I love. That's a storage REIT, but CubeSmart is probably one of my favorites REITs. Tell you what, every time I'm driving on the highway, I point at CubeSmart, literally. So
I know, going right down the street from me, I go to Aldi, and as soon as I get to the end of the road, there's one right in front of me, right next to Aldi. And I keep telling myself, I was like, I gotta buy that. I'm like, but I don't know. I already have my REITs, so it's on my list though. It's definitely on my watch list.
the dividend growth, I'm pretty sure I did a video on that recently. The dividend growth is really good for CubeSmart. And people are trying to buy a house, they're trying to store stuff. So I mean, they're making money.
Oh yeah, and the American society right now, we're hoarders. We don't like to get rid of stuff. So parents pass away, we don't want to throw away all the nostalgic stuff, so we just throw it into storage and move on from there.
Yeah, and with triple net lease REITs, one thing that I always look at is occupancy rate. If the occupancy rate is high, it's good. Realty Income, Agree Realty Corporation, NNN, those are really good.
Typically over 98% is for all of those.
Yeah, so that's a good one. One of them, just to keep an eye on. I don't know if the dividend growth is going to be there, but Motive, MDIV, Industrial REIT, monthly dividend one. They used to be part of the Rich Uncles. Remember Rich Uncles? I'm sure you saw in the advertisement. They had a separate one. I'm pretty sure that one ended up getting public. So I don't know how it's doing, but just keep an eye on that one. MDIV.
Now, how do you feel about M-REITs? Because those to me are kind of, I stay away from them. I don't trust them. So for me, mortgage REITs are just not my thing.
There is one that I absolutely love, and that's Arbor Realty Trust. That's the only one I trust.
Yeah.
And you know what? They tried to screw them over. They proved them wrong with all their articles.
I remember that. I had them at $15. They dipped down to 12. I bought a little bit more, sold out of them at about 13, made some profits on them. But there was so much at the time, and I had other opportunities. I moved out.
But that one I absolutely love. I think I'm generating 300 something quarterly with them. So I'm going to use that into buying Realty Income to get to 200 shares. So it's time to start branching out, not reinvesting it, just using that income to buy Realty Income. That's going to be the goal with Arbor Realty Trust. Nice. And if the market takes a hit, they take a hit. So, people have to be aware of M-REITs, very risky. NLY is a terrible M-REIT, and AGNC I'm not a fan of either. NLY, I think, did a reverse split. And AGNC, I mean, they may get back and better, but their business plan is not as good as Arbor Realty Trust.
Yeah, to me, it was just because of the way that they operate. There's just way too much risk in them and the potential of them going under, especially with rates where they're at right now. I was like, nah, I couldn't get myself to get into those. It reminded me way too much. Those reminded me a lot of the reason why we got the housing bubble crash in 2007 was because of things similar to that. And I'm like, ooh, I was like, just knowing that that's a house of cards that could crumble at any time. Yeah, no thanks.
And the other one that we were bringing up before we even went live was Gladstone Land Corporation.
Yeah.
So that one is net asset value starting to go up. The dividend growth isn't there, but it's farmland. So, when Trump comes in, he kicks out China and all their Chinese investing with farmland. That's a REIT to keep an eye on because they've been getting bigger and bigger and bigger each time I check their website.
Yeah, and I mean, if anybody hasn't been out to the Midwest, like I'm in Connecticut, so like you drive an hour here and you're across the state, and people don't realize how small of a state Connecticut is if they haven't gotten out of the state. But you're from Ohio. Ohio's a pretty darn big state compared to Connecticut, but then you go even further west, there's just a lot of land out there. There's so much land. It's unbelievable what's out there.
I mean, they've been expanding like crazy. So that's just one to keep an eye on.
Yeah, I'll put. And what was the ticker on that one?
LAND. Yeah, Gladstone Land Corporation. The dividend growth is not really powerful. It's like Stag. It's just it's not very powerful, but it's getting up there.
And that's one of the things I look at too when I'm looking at these is, like, for instance, Prologis, it doesn't have, a very high yield like other REITs do, pushing that 3.5 to 4%, but you're going to get equity appreciation out of it. And the dividend growth is a lot higher than you'll get out of most
Mhm.
REITs. And so that's, when you're looking at dividend investing, you look at, am I looking at it for income? Am I looking at it for dividend growth?
Mhm.
Equity appreciation is great. Typically, if you're going to get high dividend growth, you may have a small yield, but you might get great equity appreciation out of it.
Mhm.
Nvidia is a great, example of that. We just saw 150% growth in that. So yeah, the yield is, minuscule, but let's now look at that 10 years down the road. If you're going to put on 150%, 60%, 50% year after year, that's massive growth in your dividends. And that's just
Mhm.
all bonus.
Mhm.
Next year we'll most likely see from both Meta and Google, we're going to be seeing probably dividend increases from them next year as well. Let's see what the
Mhm.
percentages are going to be on those. Visa, MasterCard, Amex, all of them amazing. Double-digit percent growth on
Mhm.
dividend, but their yields are all like under 1%. So people are
Mhm.
like, meh, I'm getting an under 1% yield. I go, yeah, but you play that out 10 years, that's
Mhm.
huge what you're going to be getting on it.
Right. And just think about transaction fees. They make money on a transaction fee, Visa, MasterCard, American Express. So each time you swipe your card, they're making money.
Yeah. And so as the population of the world grows, their income grows. It's as just the money as inflation anywhere grows, they make more money. But again,
Mhm.
just going off number of transactions, people buying smaller things. Let's say we get into a recession, people still buy things. They're getting those
Mhm.
transaction dollars coming
Right.
in. That's why that's one of those. They're like a unicorn, And I just did a video on it a couple weeks ago on my top 5 dividend growth stocks, and those 3 are the top number ones for me. You can't really go wrong with them. I mean, look at they
Yeah.
boomed today because of financials. They're going to hold up really strong during any sort of downtime economic turn. The price of the stock may come down, but they're still going to have that cash flow coming in, and then you could just buy it for less. And you
Mhm.
go back in time, and I guarantee you, they're going to be increasing their dividend during tough times. That's one of the things I looked at for some of the longer term ones that I have. There were stocks that were actually still going up on their dividends during the great financial crisis. Like, that stock was beat down 40 to 50%, and they were still going up on their dividend.
I
So
know.
you're and so for me, that was one of the things I did the research on.
Mhm.
Do you use Seeking Alpha?
Yeah, I read some articles and stuff here and there. I mean, I'll Google search a stock or share or symbol, and then I'll start seeing some articles and stuff. I'm like, okay, I'm going to look a little bit more into this. But some everybody's. I mean, it's based on opinions. Some people hate realty income. Some people hate SDHD. It's like, come on, man. Just
Oh yeah, yeah,
crazy.
and I like to some of the articles. I don't read a lot of those. I mostly use it just for charts and things like that. But
Mhm.
I love it because they show the dividend history on things. So I'm like,
Yeah.
hey, what's the dividend history on this? And it'll show me. And I was like, oh, look, it went up during those times.
Mhm.
So if you can be confident that your company that you're investing in is going to be going up during hard financial times, it's a winner.
Yeah. And I mean, Pepsi, they're going to acquire a place. I'm just looking over my shoulder. I mean, I see literally like Quaker Oats. They acquire a lot of companies.
Oh
Food
yeah,
companies. So diversification is important. You should not be over diverse. You should not be over. Let's just say heavily into one sector. Tech, this and that. You should be well diversified. That's what I do. I mean, I'm REITs. I'm pretty heavy into REITs, but yes, I do have technology stocks and I have Microsoft, I have, you know, um, defense stocks and stuff, but you shouldn't be heavily focused on one sector because it can blow up in your face.
yeah, yeah. And that's one of the things. And it was funny. I went through my entire portfolio and I was like, all right, well, where am I in all these sectors? And it's like I
Mhm.
literally had 4 stocks in every single sector. And I was like, oh,
That's great.
that was a total accident, but like I couldn't possibly be better diversified. And it wasn't, I don't have hundreds of stocks that are out there, but between ETFs
Mhm.
and REITs and BDCs and tech and financials and industrials and healthcare, I'm like, cool. I was like, it happened to work out just right for me. Um,
T-Mobile too, TMUS. They
oh,
started distributing a dividend. That's one that I'm looking at.
that one I'm so mad at myself for. To me, that's one of those ones that got away. And now I would much rather have one. I was like, That one got away. I didn't get into it. Then
Mhm.
buying one that crashes and I lose money on.
Mhm.
But when Starlink teamed up with T-Mobile to do their whole setup that they're moving forward with, I told myself I should really buy T-Mobile, and I didn't.
Ugh.
And it is
It's-
up like 100-something% since then. They got the dividend. That's been growing like crazy.
Mhm.
Yeah. So it's on my watch list, but yeah, just one of those ones I kick myself for not getting into sooner.
And it's very simple being a dividend investor. Revenue trends, when it reads funds per operation, earnings per share, generating revenue, are they in demand? Boom. I mean, you're fine.
Yeah. And you look at cash flows for a company, and do they
Yeah.
have cash flows that can cover their dividend payment? And if it's under, in most cases, 60 to 70%, if it's under that, you're good to go.
Yeah.
And you look at things like Visa, who are around like 20%, you're like, well, clearly you have plenty of room to grow your dividends. So
Mhm. Yeah. It'll be very interesting. We always discuss Tesla. So hopefully, the next few years, that would be amazing.
oh yeah. And actually we'll wrap it up on this because I do have to get going. But like I do own some stocks that aren't dividends. They aren't dividend payers, but I think that they're going to be dividends in the future. So I'm adding to them now. So
Mhm.
I've got Tesla, I've got SoFi, I've got Palantir, and I've got Amazon. Do you own any stocks or ETF? Or do you own any stocks at all that don't pay dividends right now?
No,
Okay.
I if I put money in something, I want something out of it. That's just my
Okay.
philosophy.
Nope. That makes total sense. And I've contemplated that. That's why I've cut down to just those four, because I wanted to, because there are those opportunities like those that you can buy into that have huge potential growth. Like,
Mhm.
if you were buying into Facebook and Google, for the last 10 years, you would have gotten no dividends, but you would have added up the shares, made awesome equity appreciation, and then
Mhm.
boom, now have this bonus with a dividend. So the only reason I added those is because, well, I love Tesla and that's what I started this channel on. But having those, I think that that could be a potential situation down the road that we can see that, and being able to buy SoFi, I'm in under $8. So I'm like,
Mhm.
being able to add a ton of shares at a price like that to see it go in the future. So I'm trying it out. I wasn't sure if you had anything that did not pay a dividend. I figured you didn't, but
SoFi is one that I may hold on to just for the heck of it. Get 200 shares and see what happens, and just play money. It's nothing wrong with that.
oh yeah,
Palantir, I think, will have one in the future. I probably 5 years or so. I mean, their board of directors will probably. It's funny because a lot of these companies, their board of directors start saying, "All right, we're going to have a dividend," and then everybody buys them. You know,
oh yeah.
so I mean, I think they're starting to catch on that people like dividends, and come on, you got to distribute something if you put it in it.
Right. And of course, you always have to look at the company and the free cash flows, like, like a company like Tesla, and say, do we want them to pay a dividend, or do we want them
Mhm.
to reinvest that capital back into the company for future growth? And
Mhm.
typically in the early stages, you want to reinvest that back into the future growth of the company.
Mhm.
SoFi, being a financial and a fintech at the same time, might get to that point sooner just because they're a financial.
Mhm.
And they can reinvest back into the company a lot, but they
Yeah.
may get to that point of profitability where they're like, hey, maybe we can do this distribution.
Mhm.
And then Amazon, I have no doubt within the next couple of years, Amazon's going to do it. How could they not? They're going to be hitting,
Yeah.
$1 billion in revenue in a quarter, which is
I
completely
know.
insane.
Yeah.
So, or is it a billion? No, a trillion. I think it was.
Oh, they destroyed eBay too, because eBay has a dividend now, but it's. I mean, does anybody ever talk about eBay anymore? Not really.
They really? I didn't even know
Yeah,
that.
eBay has a dividend. It was decent with the dividend growth, but it's been kind of stagnant a little bit. But eBay does have one. It's just, I mean, you start thinking about Amazon and the other stuff. I don't think they can keep up with Amazon or UPS or just because I'm sorry, Amazon or what are the other ones that are out there that are pretty good?
Well, Spotify doesn't pay a dividend, but um, yeah, in that sector, I don't know who else is out
Yeah,
there.
but probably, and if you look at Intel, I mean, they went down the tubes.
Well, so from what I heard, and my dad was telling me, I guess Qualcomm was looking to buy them out, and when they took a hit like that, I figured somebody would.
Mhm.
I was guessing maybe an
Yeah,
Nvidia, but it looks like AMD is the one that's getting pushed to purchase them out. So,
Well, I'm going to tell you though, in this factory in Columbus, they're building chip factories because everybody's worried about what's going to happen in Taiwan.
yeah.
We have it here. We don't have to worry about an invasion because that would cause a lot of problems.
Oh,
China and
right.
Taiwan. I think we have a little bit more testicular fortitude with the new president coming in, so I think that'll help.
Yes. But no, I agree. And then, Tesla was basically doing the same thing. They were moving a lot of their manufacturing to the US, especially when it comes to getting lithium and other materials that they
Mhm,
needed for their vehicles, just so they could avoid anything like that. They've got everything that they need at their own disposal. They don't have to worry about
mhm.
any turmoil around the world. They'd have it right here.
And I'm
And
surprised that Elon has not had a hybrid car because it's all electric. But you know, if you're traveling a far distance, you're going to need gas. You can't just charge your car all the time. So I'm wondering if he's going to get that hybrid car.
no, because you can. I've got enough friends who have Teslas, and that's why they're just boosting up all the charging stations around the country.
Mhm.
Because you can go as far as you want. You can go across the country. You can go.
Really?
I mean, right now
I'm
the
not.
average you're going to get like 300 miles. Like a Model 3 will get about 300 miles. Model Y.
Well, that's
So
not bad. Maybe I have some knowledge, but I was just like, what happens if this happens or that happens? Because I know when I was listening to the space, Trump was talking about the hybrid cars versus 100% electric, and probably Elon behind closed doors would probably correct him.
yeah, and
Honestly.
so and I know a lot of like the legacy automotive makers, GM, Ford, they're shifting their focus a little bit towards the hybrids because of the adoption and a lot of people's uncertainty about EVs that are out there.
Mhm,
Plus, they're not profitable on EVs, but they can be profitable on hybrids. So
mhm,
that shift is kind of taking place from some of them. Tesla's never going to go that direction. It's just not going to
mhm,
happen. A hybrid underneath the hood is horribly inefficient versus one or the other.
mhm,
So it's really bad to go with a hybrid, but it's what people want to buy, and it's kind of like um, that bridge between ICE vehicles and
mhm,
EVs to get people sort of comfortable with it. And they're like, all right, well, I have my safety net of a gas tank, but I could run on my EV if I want.
mhm,
And so I think it'll be a good bridge gap in the
mhm.
time, but long term, it's going one or the other. And for the record, I'm
Yeah,
not one like all these people who are like, oh, we need to have the regulations, no more EVs or gas vehicles being sold at this time. I'm not for that. I
yeah,
think gas vehicles have their place. If people want to buy gas, let them buy gas. But if the natural over time, naturally, the cost of EVs is going to come down. The cost of
mhm,
maintenance on them is going to be a lot lower. So it's going to come down to, well, people are going to be like, for the masses, and say, I don't want to buy this ICE vehicle because it's going to cost me more money up front and more
mhm.
money in the long run. I'll just buy an EV because it's better for my budget. And then naturally, that's going to take place. You don't need to force people into that. It'll just naturally happen over time.
And
Um,
I've noticed too with Exxon is they're starting to adapt and they're starting to go to the charging and stuff too. So that's quite interesting. The way a lot of these energy companies are adapting. And I think that's huge. If you don't adapt, you're done.
Oh yeah, and that's really what it is. I mean, the companies are so big, and they're like, obviously, they're not going to go away. These companies have been around for over 100 years. They've
Hmm.
faced all sorts of challenges along the
Hmm.
way that they've had to overcome. It'd be stupid of them to not see this coming. They obviously see it coming.
Yeah.
So just like Saudi Arabia out there buying up Lucid themselves, Saudi Arabia being obviously the oil giant that they are,
Hmm.
working on electric vehicles and different sorts of renewable energy themselves, knowing this is the way of the future, and then buying up a ton of sports teams as well because they need to make their money somewhere. So
Yeah.
and again, you're right. They're smart. They're not going to be stupid. That's why I don't
Mhm.
mind owning ExxonMobil as a stock. I don't mind owning Occidental. They're going to figure it out. And oil is still going to be needed for decades and forever for some things.
Yeah.
So
I would love for Saudi Arabia to buy the Cleveland Guardians and change them back to the Cleveland Indians so we can win a championship and compete with the Yankees. That'd be amazing. If you're
oh,
from Saudi Arabia seeing this, please do it. The
oh,
one's trying to steal my
that would be
heart.
awesome. Yeah, I'd
Yeah.
be for that as a baseball fan. And I did love the fact that this year it was very much reminiscent of Major League,
Hmm.
but it just didn't have the same name. But I did
Yeah.
like how they put up a fight this year. It was good.
Yeah. But the Dodgers and Yankees, I mean, it's like Exxon and Chevron. I mean, you got the juggernauts.
Yeah, and Chevron's one I was going to get into. I picked Occidental instead. I've got my
Mhm.
2 oil plays. I'm cool with those, but you really can't go wrong with most of them, especially
Yeah.
the big names. Yeah, you'll be fine with all of those. Well, I'm gonna get going. I've got to get to bed because I have to get up at 3:15. But uh,
I didn't know that.
oh no, I'm cool, man. This has been awesome. So thank you so much for being on here. Is there anything else you want to share? And if you guys don't follow him, go subscribe to his channel, Darth Dividends. He's on X, he's on Instagram. Definitely check him out all over the place. What else you got for us?
We'll have to do round 2 soon. You just let me
Definitely.
know. I mean, I have way more time now. I'm not sitting down and studying all day or making police reports with people fraudulently using my card. So I got time.
That's awesome. And you guys can let us know in the comments as well what day works for you. Because if we want to do a weekend and we could do a longer session like this, we'll do that. Whatever's up to good for you guys. I'm usually good every weekend. So you guys in the comments, let us know what you guys want to do.
And I will sacrifice my Sunday so I don't have to watch the Browns. So I'm okay with that. I'm
Yes,
okay with that.
we'll pick right during the time that the Browns are playing to be on
Yeah,
here.
because I
I'm a
already
Panthers
know.
fan, so I understand. All right, man. Well, thank you so much for being on here. I appreciate it. This has been awesome. Thank you guys as well. And we'll catch you in the next one.